The accounting aspects of mergers. So there are two basic methods that can be used to account for mergers. We have the purchase method and or the pooling of interests method. So first, we have the purchase method. In the purchase method, the total value paid or exchanged for the acquired firm's assets is recorded on the acquiring company's books. The tangible assets acquired are recorded at their fair market value, which may or may not be more than the amount of which they were carried on the acquired firm's balance sheet prior to the merger. And so sa excess sa total value paid to the fair market value, it is an intangible asset termed as the goodwill. The term intangible asset of goodwill is significant for many companies. For example, when Philip Morris purchased Kraft Incorporation in 1988 for 12.9 billion, the fair market value of Kraft's physical asset was about 1.3 billion, and sa difference niya is 11.6 billion or the 90% of the purchase price, which represents the intangible asset of goodwill. Second is the pooling of interests method. The acquired company's assets are recorded in the acquiring company's books at their cost, net of depreciation when originally acquired. Thus, any difference from the purchase price and the book value is not recorded on the acquiring company's books, and no goodwill is created. Wala siya goodwill. The advantage of pooling of interest method is that the reported earnings will be higher under the pooling method. This is because the depreciation will not be more than the sum of the depreciation charges prior to the merger. And since walay goodwill nga nahimo sa balance sheet in pooling, it will not appear in amortization charge on the acquiring firm in the income statement. So let's look at the example wherein Company B acquires Company A's outstanding common stock for $10 million. The book value of the acquired share is $7 million. So we'll see the results of this merger according to both the purchase and pooling of interests method. So first, in the pooling of interest method, we can see that the two balance sheets are combined, and the 3 million difference between the purchase price and the book value of Company A stock is not considered. So as you can see, the pooling of interest method gives in the Company B after acquisition of Company A gives us $60 million of the total assets, $18 million of liabilities book value, and $42 million of stockholders' equity book value. There is a negligence of the difference of 3 million. It is not considered in there. But in contrast, for the purchase method, the 3 million difference between the purchase price and the book value is recorded on both sides of companies B's post-merger balance sheet as an increase in total assets and as stockholders' equity. You can see that there is an increase of 3 million at the total assets book value in the purchase method, so as in the stockholders' equity in the purchase method as well. This is because of the difference from the total assets and the stockholders' equity of 3 million. The book value of a Company A's asset is $10 million. Suppose that the market value of the Company A's asset at the date of acquisition is 11 million. Company B paid $3 million above the book value of stockholders' equity. Of this 3 million, the 1 million difference between the assets' market value and book value is recorded on the balance sheet in the appropriate tangible assets accounts, while the 2 million is recorded as the goodwill. And the tax aspects of mergers. Tax is very important in determining how an acquired company's shareholders could receive compensation for their shares. So the merger transactions that are effected through the use of voting equity securities are tax-free, such as the common stock or voting preferred stock. So if an acquired company stockholder have a gain on the value of their shares at the time of the merger, the gain is not recognized for tax purposes if these shareholders receive voting equity securities of the acquiring company. Any gains are not recognized until the newly acquired shares are sold. And in contrast, if the acquired company shareholder received cash or non-voting securities, such as debt securities, non-voting preferred stock, or warrants, in exchange for their shares, any gains of that are taxable at the time of the merger. When in partial cash down payment situation, the seller can spread the tax liability that is created over the payment method. For the valuation of merger candidates. The valuation of merger candidates is an application of the capital budgeting techniques. The purchase price of a proposed acquisition is compared to the present value of the expected future cash inflow from the merger candidate. And if the present value of the cash inflow will exceed the purchase price, then the merger project has a positive net present value and is acceptable. And in case of common stock, which is actively traded, the market value of the stock is the key factor in the valuation process. To make the stockholder give up their shares for the cash and or securities of the acquiring firm, they have to be offered a premium over the market value of the stock prior to the merger announcement. And a 10 to 20% premium is the general consideration of a minimum offer. Even though the stockholders may hold out for much better offers, either from the company making the initial offer or from other interested companies. The valuation techniques. There are three major methods that are typically used to value merger candidates. We have the comparative price-earning ratio method, the adjusted book value method, and the discounted cash flow method. First is the comparative price-earning ratio method. It examines the recent prices and price earnings or PE ratios paid for other merger candidates that are comparable to the company being valued. In a scenario, if the two companies in a specific industry were recently acquired a price earning ratio of 10, then the comparative price earning ratio method suggests that the price earning ratio of 10 may be reasonable for other similar companies. The financial analysts who use this method should exercise caution and determines whether the companies being compared really are similar. Second is the adjusted book value method. It is used in determining the market value of the company's underlying assets. For example, suppose a company has an equipment fully depreciated on its book value but still in use. The market value of this equipment is determined, and then the company's shareholders' equity is adjusted by the difference between the asset's book value and its market value. Financial analysts who use this method should exercise caution because the determination of the market value of the merger candidate asset may be difficult. The discounted cash flow method. This is used in calculating the present value of the company's expected future free cash flow and compares this figure to the proposed purchase price to determine the proposed acquisition's net present value. Ang FCF or the free cash flow concept is used in long-term corporate financial planning and in evaluating the acquisition of a firm or a portion of a firm. The recognized funds generated by the ongoing process must be set aside for investment in the firm. Therefore, these funds are not available for their distribution to the firm's owners. The amount recognized by the free cash flow must be set aside for their investment in the firm and must not be distributed to the firm's owners. The free cash flow can be computed as FCF equals CF minus L times 1 minus T minus DP minus PT minus B minus Y, wherein CF is the after-tax operating cash flow, L is the before-tax interest payments, DP is the preferred stock dividend payments, PT is the required redemption of preferred stock, B is the required redemption of debt, and Y is the investment in property, plant, and equipment required to maintain cash flow at their current levels. And with free cash flow, it could represent the portion of the firm's total cash flow available to service additional debt, to make dividend payments to common stockholders, and to invest in other projects. And in valuing takeover prospects, it is very important to recognize the explicit cash outlays, which is normally required in sustaining or to increase the current cash flow of the firm. For example, in the consideration, the acquisition of an oil production company, it is not correct to project current depleting resources that require continual, significant investment to ensure future cash flow streams. And also, the free cash flow from a merger should include any effects of synergy, because the marginal impact of the merger on the acquiring firm is of interest to us. Let us try to look at the example. Suppose the annual after-tax free cash flow from a merger candidate is calculated to be $2 million and is expected to continue for 15 years, at which time the business can be sold for $10 million. If the appropriate risk-adjusted discounted rate is 14%, for example, the present value of the expected cash flow is as follows. So we need to get the present value of an annuity of $2 million for 15 years at 14%, plus the present value of $10 million in 15 years at 14%. To get the present value and the present value of an annuity, we could do the manual computation. First, you need to add 1 and 14% or 0.14 as the rate, which would give us 1.14. Then press the division sign 2 times. Press also the equal sign depending on the number of periods, and to the case, which is 15, so 15 times in pressing the equal sign, which will derive as at 0.1400962 or the 0.140. That is the present value. And as we continue, we're gonna get the present value of an annuity. The answer from the present value must be deducted by 1. The answer of it will be negative 0.859903. We're gonna press the plus minus sign to make it positive, and then divided by 0.14, which will give us 6.142. And then follow the next step, multiply those numbers by its corresponding rate, which will give us a positive answer of 13,684,000. Therefore, if the merger candidate's purchase price is less than 13,684,000, the proposed merger has a positive net present value and is an acceptable project. To make things easier in finding the present value, you could refer to the present value table, as well as it is a way of checking if we are right or correct. So just follow the interest rate and the periods, and as you can see, we're on the right track. Most financial analysts who work on proposed mergers use all of these methods to attempt to value merger candidates. In addition, they consider a large number of other factors to valuing merger candidates, such as the merger candidate's management, products, markets, distribution channels, production costs, expected growth rate, debt capacity, and reputation. And that's it for this video. Thank you for watching and listening, everyone. This has been Michael C. Sonoria, a BSA 2C student, signing off and thanking you.